Have you ever pondered on how to determine a company's overall worth? Not just its market price, but the total value. Welcome to Value View, where we explore the world of and help you make informed investment decisions. I'm Ravindra, and today we're delving into a significant metric that's frequently employed by investors, analysts, and financial professionals. We're delving into a powerful metric that's often used by investors, analysts, and financial professionals to evaluate a company's financial health and performance. It's called the enterprise value to earnings before interest and taxes, EV/EBIT ratio. To assess a company's financial health and performance, that metric is the enterprise value, or EV. It's not solely about market capitalization. It's about taking into account both debt and equity. It's about comprehending the more extensive financial perspective of a company. Now that you're acquainted with what enterprise value is, let's dissect how to calculate it. Calculating enterprise value might seem complex, but once you understand the components, it becomes a smooth process. First off, let's take a look at market capitalization. It's simply the current share price of a company multiplied by its total number of outstanding shares. In essence, if you were to buy all the shares of a company at the current market price, the total cost would be the market capitalization. Next up, we have debt. This includes all the short-term and long-term obligations a company has. It's important to include debt because if you were to buy the company, you'd be responsible for paying off these liabilities. The third component is preferred stock. These are shares that have a higher claim on a company's earnings and assets. Unlike common shares, preferred shareholders receive dividends before common shareholders. Finally, there's cash and cash equivalents. These are the most liquid assets a company owns, including cash in hand, in the bank, and short-term investments that can be quickly converted into cash. So let's say we have a company with a market cap of $5 billion, a debt of $1 billion, preferred stock of $500 million, and cash equivalents of $200 million. Using our formula, the enterprise value would be $5 billion plus $1 billion plus $500 million minus $200 million, which equals $6 billion $300 million. With these figures in hand, you can accurately calculate a company's enterprise value. You might be wondering, why does enterprise value matter? Well, let's delve into that. Enterprise value, or EV, is a crucial piece of the puzzle in business analysis and valuation. Unlike market capitalization, which only reflects the cost of buying all of a company's shares, EV goes a step further. It takes into account the company's debt, preferred stock, and cash equivalents. In essence, it provides a more holistic view of a company's total worth. Imagine you're considering buying a house. You wouldn't just look at the asking price, right? You'd also factor in the mortgage, property taxes, and the cash you'd need for renovations. Similarly, when you evaluate a company, you need to look beyond the market cap. You see, EV doesn't just tell us the price tag of a company. It tells us about the company's financial health, its risk level, and its future growth potential. EV equals sign market capitalization plus total debt plus preferred stock, cash and cash equivalents. Let's say we have a hypothetical company. Market capitalization, $500 million. Total debt, $200 million. Preferred stock, $50 million. Cash and cash equivalents, $30 million. We can plug these values into the formula. EV equal, sign $500 million, market cap, plus $200 million, debt, plus $50 million, preferred stock, $30 million, cash. EV equal, sign $720 million. So this company has an enterprise value of $720 million. EBIT is calculated by subtracting the operating expenses from a company's revenue. It's essentially the profit a company makes from its core operations. What's the significance of the EV/EBIT ratio? It's a simple formula. EV/EBIT equals sign enterprise value, earnings before interest and taxes. So the next time you're evaluating a company, don't just look at its market cap. Consider its enterprise value to /EBIT ratio to get a fuller understanding of its true worth.